Sherpa here. So over the weekend, CNBC ran a story that popped up in my feed. It was actually really cool because I was doom scrolling and I saw this article and it said some high earning investors will soon owe taxes on years of deferred capital gains. And I was like, whoa, wait a second. That kind of sounds like maybe opportunity zones. And so I clicked on the story. I got sucked into all of the crazy ads that pop up on there. But once again, I got to give them credit because this is actually a really good article. They did a great job of walking through the whole country. What I've been telling everyone all year is that namely that $75 billion in deferred capital gains. And actually those numbers are actually probably light. So I think it's closer to 150 to $200 billion are going to come due on December 31st of this year. This is from Treasury because they cite a study that Treasury released that was based upon tax returns. 8996s, 8997s. They pulled directly out of that, consolidated it, and it's really cool, the numbers, that there's around 41,000 individual investors that have gone into qualified opportunity funds. And if you're one of them or you advise one of them, this story is literally about you. Now, they got the big picture right, and I'll give them credit for that. They actually did a great job. But there are three things that this story did not tell you, and one of them could change what you actually owe. So let's walk through it. All right, so as we go through this, right, so it's actually kind of cool. They hit the key points right up top here. I love this little opportunity zone graphic here. Something tells me that probably wasn't an opportunity zone, but we won't tell nobody, right? Mama said that a little white lie is okay. As you guys remember, that's from Forrest Gump when he's talking about playing ping pong. Some high earning investors who deferred capital gains, right, are going to have a tax coming due. That's absolutely right. And right, that if they got in before 2019, right, then they are going to end up paying less, right? So if they were in for 2019, they're going to get a 15%. If they were in by 2021, you're going to get a 10% reduction. This goes through 12,800 qualified opportunity funds in existence at the end of 2024. So this is actually a little bit dated too, but we haven't filed 2025. 41,000 investors, right? No surprise. Housing, property upgrades, right? There's a whole, the gamut. They run the gamut relative to what people are investing in. All right, this is actually something interesting that I did not know, is that 85% of the investors are individuals, but the remainder are corporations, according to research, right? So that's 15,000, right, or 15% of the 41,000, right? So I guess it's less than 15,000, but 15%, that's actually a lot more than I thought. And this is interesting that they typically skew wealthier. The typical individual investor has adjusted gross income of $738,000 in 2024. That's definitely high, but I think that one of the reasons why that's so high is because we had a whole bunch of whales, right? Really wealthy people that have massive amounts of income that are investing in opportunity zones because people understand that this is a really good way to mitigate taxes. Now, Treasury, if you're listening, man, give us that 10 grand where we could bring in non-capital gains money, because let's face it, most people that have capital gains skew higher on the income scale. So let's bring in that $10,000 non-capital gains exemption and let's get that number down. Let's get it down into the lower income areas so that, everyday folks can play. All right. So now let's talking about that, what capital gains rates are going to be. Hopefully they've planned for it and realize that they're going to owe the taxes on these gains. That's a big quote from Ryan Firth. Big shout out to him. You're exactly right, Ryan. I hope that they've planned for it, but that doesn't necessarily mean that you got to have the full liquidity, because we're going to show you we're going to talk about some tricks that you could use in order to reduce that gain from what you originally thought you were going to pay. So like I said before, if you're in by 2019, you get a 15% reduction. If you're in by 2021, you get a 10% reduction. And so those folks are going to pay less taxes. And we're going to have videos about how you actually do that, how you actually report that 10% or 15% basis step up on Form 8997. So stay tuned for that. Go to our YouTube channel. It's youtube.com/OZPros, and we're going to have that video right there. And actually, if you want to like and subscribe, you're going to get notified when we put that video out. Like he said earlier, hopefully they've planned for it, right? And once again, we got shout outs for our boy Jason Watkins, my buddy Jason Watkins at Novogradac. Man, they got all kinds of quotes in here, right? Because some funds have provided liquidity in the form of cash, right, that they've paid from income, or in the form of a cash out refinance. And I would highly doubt, once again, I would agree with Jason where he says that it's unlikely, right, that they're going to cash out their interests in order to pay the taxes and step away from the biggest benefit of opportunity zones, which is that step up in basis to fair market value. Great quote there, Jason. Love that, because I would absolutely agree. Now, some of the tax benefits are going to change as of 2027. Rural investments get boosted tax incentives. They want to drive capital to the rural areas. And so if you end up putting 90% of your fund into qualified opportunity fund investments that are rural in nature, which means they're less than 50,000 people or not adjacent to a census tract with 50,000 people in it, then you're going to get a 30% step up in basis under OZ 2.0. Every other deal is going to get a 10% step up. So in 2021, it was amazing how many people invested into opportunity zones because of that 10% benefit going away. I hope that the same 10% benefit, that people understand how valuable that is, and that starting January 1, 2027, that opportunity zones become a go-to for folks relative to deferring capital gains. And so take a look at the investments that are out there. If you've got a massive capital gain, you need to be looking at setting up your own captive qualified opportunity fund. I shot a video about why everyone should have, certainly any high net worth individual should have their own captive qualified opportunity fund, because you can invest into other professionally managed funds. It also gives you a significant period of time for you to defer the gains, for you to figure out what you're going to do. And then it allows you to do your own deal if you so choose. So I'm a huge fan of captive qualified opportunity funds. All right, so the three things that the article missed. One, the lesser of rule and valuation discounts, right? So when Congress passed this legislation, they had to tee it up so that if your investment went down, that you didn't have a phantom capital gain based upon your original gain. So what they said was you either pay the lesser of your original capital gain amount, the tax on that, or the value of your QOF investment as of December 31st, 2026. So if your investment has gone down, or if your project is still under construction, it presents a unique opportunity to be able to take a discount on paper and still be able to hold your investment and ultimately get the value and the tax benefit after the 10-year hold. But it's a finite period of time. It is on December 31st, 2026. So that presents a significant opportunity for people to take advantage of discounts for lack of control. And discounts, this is a big one. I've got another article, and I'm going to be doing a video on this, on a discount for lack of marketability. Because, man, by very definition, when Congress enacted 2.0, they set it up so that if somebody's got a gain and they have the ability to be able to go into 2.0, they're probably going to do that. So it presents somebody with an opportunity who has capital gains this year to potentially invest into something that they can get a valuation discount on. This is also available for somebody who's got a K1 gain all the way back to January 1st of 2025. So if you have a gain that came from a partnership or an S corporation, or one of your clients do, then you need to take a look at that, and you need to see if it makes sense to drop it into a captive fund and or another deal that's under construction right now, so that way you can take advantage of this one-time opportunity to be able to write down and take a valuation discount at the end of the year and potentially pay 40% less in taxes, potentially upwards of 50% up in taxes or less in taxes based upon what the status of the project is. So that also brings me around to a great point. If you are a CPA or you're a financial advisor, we have tons of you guys as clients, and they come to our mastermind on a weekly basis and they ask questions. They ask them on behalf of their clients. They take the answers back to them, and they use that as part of their strategy for making sure that they're dealing with these tax situations as adeptly as possible. So we also represent and we work with a number of substantial CPA firms where they bring us in as their opportunity zone expert. They know they've got clients that got OZ deals going on, and there's nuances to the program. And so you need somebody that's doing this day in and day out. That's what we do for these firms. Whether it's advising on nuances or actually reviewing the tax forms, we'd be happy to do that. But the key thing is that we are getting ready to get busy, right? Because everybody out there, all 41,000 of those investors, has a capital gain that comes due at the end of this year. So guess what they're going to be doing? They're going to be calling experts who have experience in this field. And so you want to make sure that you get on this early, because the valuation discount, right? And the ability to be able to potentially safe harbor 1.0 deals going into that aren't going to be eligible for 2.0. All of that expires at the end of this year, according to the notice that we just got back from the IRS. So that's the real story. The deadline is real, the number is real, and now the whole country knows it, which means that everybody, like I said before, all 41,000 of those people are going to be calling the same short list of professionals at the same time this fall. And it's wacky. It's almost like people start like paying attention to taxes. It's like when they go back to school. I guess it's like new school year, new tax year. But make sure that you're on the front end of that, and that you're not, calling at fall break or Thanksgiving break, or God help you, at Christmas break. Because if you are, you're probably going to be too late. So the coverage in the story told you to get liquid, right? But once again, there's opportunity to potentially do that valuation discount. But there's also a stack of moves for whatever's left, right? We've got a number of different tax mitigation strategies that we can deploy in addition to that valuation discount, or if you're not going to take a valuation discount, in lieu of that, in order to lessen your tax bill. But every one of them rewards starting early. So here's what to do. Go to ozpros.com/connect. Tell us where you stand, your gain, your fund, your deal, or your client's situation, and we'll point you in the right direction. And if you'd rather just talk it through, book the free 15-minute call on that same page. No pitch, no pressure, just help. Sherpa out.